Okay. What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Crowdstrike. This has always been a popular stock the last couple of years, and the stock has had a pretty nice run here, up 245% in the last 5 years. But we're going to do some analysis to see, am I interested in this stock? What price would I buy it? And all that. So, CrowdStrike is a cybersecurity company, if you don't know. The market cap right now is $127 billion. And if we look at this company's numbers, we can see that the revenue trend is very nice. Okay. A couple years ago, they did 1.4 billion in revenue. Now they're up to 4.3. And, really, when you look at it like that, 4.3 billion in sales is not a lot for a company valued at $126 billion. Then we get into their EBITDA, their net income, which starts to look terrible, and they're losing money. The free cash flow is positive. Okay, so obviously there's some non-cash charges that are affecting its net income. So we have that. EPS is negative here, but according to Yahoo Finance, it's actually positive. So there's some difference between GAAP and non-GAAP when you compare this site to the other site. Cash to debt ratio, we have about 5 billion in cash, 700 million in debt. So that's actually pretty good. Shares outstanding is slowly increased. Well, this year it was down, but it really looks like it's uptrending, so that's not good. And then what else do we got here? The valuation is just ridiculous on this. A P ratio of 113 and then 4P of 137. That's crazy. Now, since they're typically a money losing company, I have to use a price to sales history instead of price to earnings. Right now, they're at a price to sales of 28, which is insane. And a stock like a company like this it's really an exception. It's really a crazy scenario when you see the lowest price to sales this company has been at is 11, right? And it's been up to a 53 price to sales. For most stocks out there, these are the type of numbers you would see for a company's PE ratio, 11 to 50, right? We're talking price to sales. The PE ratio is in the hundreds. And for pretty much every stock out there, that doesn't last longer than a couple months, maybe up to a year at most. Um, but this stock has kind of been an exception. Not it's not that their valuation is traded that high for years, but I think since their net income has bounced around a little bit, it's gone from, their peak was 170 million last year, and then now they're back to losing a couple $100 million. But other than that, I mean, the price of sales of 28 is crazy. I mean, if this stock dropped in half and went down to a price of sales of 14, I still don't know if I would buy it because, typically when I see a company that's losing money and doesn't have, you know, like a trajectory of positive growth coming, I say don't value the company at maybe like $20 billion at most, right? So, but by the time you get to a number like 125 billion, I'm thinking that's so far overvalued. So that's kind of the way I look at it. We can come down here and see okay, so Robinhood, wow, all sellers, um, mostly selling from hedge funds and then just not much activity, mostly selling too from insiders. So I don't know. This just looks like a mess here. I would not want to be involved in a stock like this anywhere near these valuations. I would say if it dropped 75%, it would be interesting, which I wouldn't be surprised if that's what happens. Like I think the stock should probably come down to whatever, $200 or something. So that's kind of the way I look at it. The only thing they got going for them is this revenue growth. That's it. Okay, and it's not like they're growing 100% per year. They're now down to, in the 20s, 25% or so. So it's not great here. That's great they have positive free cash flow, but it's $1 billion of free cash flow. So that's the bottom line. Is this any way you look at it, the stock's overvalued and I wouldn't invest in it anywhere near this price.